Hey guys, in today's episode of the Learn Like a CPA podcast, we're going to talk about syndications. What are they? Who are they for? Who are they not for? And all the pitfalls and traps that you have to look into before you enter into one of these deals. So there's going to be a lot of good stuff in today's episode. So sit back, take some notes, and let's get right into it. Hey guys, before we get into the episode today, I really want to shout out my Facebook group, Tax Strategies for Real Estate Investors. So we have over 5,000 real estate investors in this group from all walks of life. We have long-term rentals, multifamily, mid-term rentals, short-term rentals, commercial properties, syndications, and everything in between. We have people that are co-hosting in there. We have people that are property managing in there. So make sure to join today because we talk about all sorts of things between tax strategies and real estate management, portfolio management, and absolutely everything you can imagine. So if you have questions for me, this is the easiest way to get access to me is to join this group and ask your question. So without further ado, let's get into the episode. So getting into syndications, a lot of people ask, well, what are syndications? Kind of how do they work? What is my expected return on those? And what does it look like to be a limited partner in a partnership, right? Or a syndication. So we're going to talk a little bit about what they are, who they are for, who are they not for, what type of returns can you expect to see from them, what sort of tax benefits can you expect to get out of them, and some things to watch out for, and then just an overall wrap up of how it applies to your situation. So to start off, a syndication, typically what you'll have is you'll have a fund sponsor. These are normally considered the general partners. So I'm personally actually a general partner on 2 syndications right now. We have a $3.8 million project going on in Branson, Missouri, as well as a $2.5 million project going on in Black Hawk, Colorado, as well as an $8 million project going on in San Marcos, Texas. So I'm personally a GP or fund sponsor for a few different partnerships. And so these are normally made up, you'll have about four partners, 4 general partners, and then the rest are going to be limited partners. Now you could have, 5 limited partners, you could have 10 limited partners, and that really all depends. As a limited partner, you are responsible for contributing capital. Pretty much as a good general partner fund sponsor, it's my responsibility to assess your kind of risk appetite for these type of investments. So I'm going to ask you questions about, where do you want to invest at? What type of returns are you looking to see? Whereas a limited partner, you're responsible for contributing capital, whereas a general partner is going to be responsible for running the day-to-day operations. Generally speaking, as a limited partner, you can expect to earn about cash flow of about 7 to 8% a year, and an internal rate of return over the overall project anywhere between 16 to 21%. I mean, most of the time, you could probably get anywhere in between there as far as an overall total return there. Most syndications will hold on for about 5 years with a possible buyout of the limited partners in year 3. So who are they for? Well, people who do not have experience operating rental real estate, but still want the advantages that come with real estate investing. So, what I see with this is kind of, you might have a doctor, a dentist, a high earning professional, maybe an attorney who they understand that real estate's important for their wealth building strategy when it comes to, equity pay down, tax benefits and appreciation, and they want to diversify their portfolio a little bit, just from the stock market, bonds and mutual funds, etc. So these are typically high earners, who don't have time to manage their properties. This, generally speaking, this is who they are for. People who are unable to qualify for conventional financing. So I might be, a wealthy individual, or maybe, even in my situation, leaving my W-2 job a few years ago, it takes a while to qualify for conventional financing if you're self-employed. And so I had to go down the non-conventional route of using DSCR loans and bank statement loans and investment vehicles with really worser terms, worser rates. And well, when I couldn't secure conventional financing, one of the things I could have done was invest in a syndication because I don't need to really take out loans in my name. Individuals with a net worth of $1 million or more are going to be considered accredited investors. And these are typically people that syndications are looking for, although it doesn't have to be that way. But most syndications are going to require that you're accredited. And so at my CPA firm, we sign off on these letters all the time. We'll verify somebody's net worth statement or check out their income on their tax returns for the last few years, especially if we prepared them, and sign off on that. And so I'll touch a little bit on that requirement. So you either need to have $1 million net worth excluding the home equity that you have. So your primary residence for purposes of determining net worth does not count for accredited investor per the SEC. So you have to back out the value of your primary home. Or, like I said, either you could have either $1 million net worth, or I believe you have to have about $200,000 a year if you're single, and about $250,000 a year if you're married, filing over the last 2 years. So those are the two ways you can become an accredited investor. So who are they not for? So they're not for individuals who want to achieve a higher cash-on-cash return, right? Because in real estate, there's probably a heat chart between the amount of work that you're willing to put into something and the amount of return on investment you're going to get. If you're not the one analyzing the numbers, running the deal, putting the deal together, well, it makes sense that you don't get as high as a return as if you were just kind of sitting back and writing checks. So expect to, if you are somebody who wants to achieve a high cash-on-cash return, you're not going to want to do a syndication, because you're going to be parking your money in this thing that, like I said, at best might get you 7, 8 to 10% cash on cash and then some sort of exit. People who are just starting off in real estate in their journey, they're much better off putting in sweat equity, and instead of trading, time for dollars, they're trading their value for dollars. And so if you're just starting off, you're probably not going to look into syndications. People who want control over their real estate decisions, right? So if you want to have control over what's going on, you do not want to be invested in syndications, because the fund sponsor is typically the one that's able to make that decision for the investor group, and you don't have as much say in the overall investment journey there. People who have access to traditional financing, especially conventional financing, you can very well as go out and get loans in your own name or in your LLCs. You don't really need to invest your money with anybody else. Individuals with less than $1 million net worth. So this is important because of, like I said, accredited investor status, but more so, if you don't have a net worth of, at least $1 million, to invest $150,000 into a syndication that's going to hold up your money and tie it up for a few years, 3 to 5 years, that's a really risky play, I think, for somebody with less than around $1 million net worth. So think twice about before you go and invest in syndications because of those reasons. So what type of returns and sort of exit period can you expect out of them? Well, like I said, you'll typically expect about a 7 to 8% cash on cash return every single year. Typically, the limited partners will actually get their money paid back first. So in most operating agreements, there's some sort of waterfall structure where the limited partners will get their, they'll get paid, they'll get profits, they'll get their capital paid back before the general partners make any money. Most of the time, you'll also expect, like I said, anywhere between a 15 to a 20% internal rate of return on a project. So that's the overall total, summary of the return when you factor in the appreciation, you factor in the equity paid on, and then you factor in the cash flow. Generally, you'll have a 5-year hold period. Most deals, that we're seeing and we're doing are written on a 5-year mark, where it's, hey, in year 1, we're going to buy this asset, we're going to get it stabilized, we're going to get it up and running and rent it out. Potentially look at a refinance in year 3 abouts, and then looking at a sell or what we call a reversion in year 5, where we kind of exit and take our money and move on to the next project. Now, a fair warning, if you're a limited partner, expect the general partners to maybe try to buy you out of your equity. This is a common strategy between fund managers and general partners is, we want to have most of the gains and the appreciation to ourselves. So what we'll look to do typically is at that year 3 mark, because now we have a stabilized asset for the most part. We're able to go to the bank and get a refinance if terms are right, pull a significant amount of money out, and then pay off our limited partners as investors, and then give them insane returns to basically buy their equity out. And so then now as a general partner, we have all the equity, and then we're able to sell at year 5. So what sort of tax benefits can you expect out of syndications? Because, obviously me being the CPA and the tax expert, a lot of people want to ask that. Well, the first one has to be with passive income. So the income that you get from a syndication, whether it's you're doing real estate or apartments, car washes, drilling, if you're doing RV parks, self-storage, whatever it is that you're doing, it's considered passive income to you, right? Which means you can use other passive losses to offset that income. So maybe I have, syndications coming in, there's a lot of money coming in, but I have rentals in my own portfolio that I'm able to do, cost segregation, generate losses on, and I'm able to offset those all the time. Now, you're going to get that same accelerated depreciation. You're going to get those favorable capital gains tax that we talked about, tax-free refinances and return of capital. Now, one of the interesting things when we talk about is, is these idea of passive losses and passive income. And so what I normally see is especially in the short-term rental space, because that's what I've been dealing a lot with lately, more so than multifamily and long-term rentals, is that people will buy a few short-term rentals, let's call it 2 or 3 short-term rentals, figure out that they're actually a lot of freaking work. And after that year 2 or year 3, they want something that's more passive. Well, you can actually take your money that you're earning on those short-term rentals, invest into a syndication as a limited partner, and use the losses that the limited partnership is going to generate, and use those to offset the income that you have from your short-term rentals. So it is a great exit strategy for somebody who is scaling a rental real estate portfolio but doesn't want to do any more day-to-day management. Consider taking your money and dumping it into a syndication instead. Now, things to look out for as a limited partner: make sure you have debt basis in the partnership. This typically means that you're going to have either qualified non-recourse debt, or recourse debt in the partnership. You want to be at risk for some of the debt as an LP, because that gives you what's called debt basis in the partnership, which is just a fancy term for being able to deduct your partnership losses. Okay, it's just a tax terminology thing there. Double check that, whether it's with your accountant or the fund manager. Double check that you actually have debt basis for the losses. Now, one thing to point out: if you are a limited partner, you are not going to be able to deduct the losses from the limited partnership, the syndication, against your W-2 income, because you do not manage that property yourself. You don't self-manage it, you don't run it. So you're not going to be able to take the losses from the syndication to offset your W-2 income or business income, but you can use the losses from the syndications to offset other passive income or gains. So we see this a lot kind of with clients as an exit strategy. Let's say you've had a rental for many, many years, and now your basis is extremely low. And so when you go to sell that property, you're going to have depreciation recapture, you're going to have a big capital gain, you're going to have all these gains taxes hitting you. Well, one of the ideas is take the proceeds from that sale and invest those in the syndication that's going to generate you losses that you're going to be able to use to offset your gains. And just make sure you do that within the same calendar year. Or a strategy is what we call stacking. So if I know, let's say it's 2023, and I know in 2024 or 2025, I'm going to have this huge gain, right? I have this rental doing really well. I'm going to make a couple $100,000 from it. Well, if I know that, what I can do is I can actually stack losses prior. So what I might do is I might invest in syndications this year and a little bit of next year, with the idea of using those losses to offset the expected gains in the future. Okay. So some things to watch out for. So first, understand if a syndication applies to you based on what I had said before, right? Watch out, kind of look at, where's my money best spent? If you're just scaling your net worth in your portfolio, maybe your money is better spent in properties that you manage yourself. You have more control over everything, right? But if you are someone who doesn't want to manage anything and you might have a higher net worth, well, maybe syndications are a great option. Watch out for bad operators and people with no track record. So these are going to be fund sponsors who maybe it's like their first deal or something, or they're really fudgy with the numbers and they can't really promise returns. Watch out for bad operators. Watch out for operators that are also using aggressive debt strategies. So you'll see some fund investors that will try to do 30-year interest-only loans and with a balloon payment at the end, or some of these other creative strategies. Really watch out for those, because those deals can crash and burn depending on what the market does with interest rates. Review your operating agreement and your package before signing in. So typically the fund will have an operating agreement between the general partners and the limited partner that's going to outline the terms and conditions. Please review this before you go. Again, make sure you have debt basis for losses for tax purposes. Okay, so make sure that the fund is allocating you debt for tax purposes, so that way you can be able to use those losses. Be very mindful of when the fund is going to sell or liquidate. You do not want an unexpected tax burden. So if let's say I'm holding a syndication and I buy it in year 1, we do cost segregation, so I get a lot of losses there, and I don't expect it to sell until year 5, so I'm not really planning on it, and then all of a sudden it sells in year 3, right? If it sells in year 3 and I'm not expecting it, I'm going to have this huge tax burden that I have to figure out how to offset. So make sure you're staying in touch with your fund manager or the syndication sponsor. Make sure you're staying in touch with them to figure out, when do they think that this project's actually going to liquidate. So to wrap it up here, Syndications are definitely not for everybody, but they can be a great way to diversify your portfolio and your income streams and take a little risk off your shoulders. Like I said, I've seen plenty of investors where, maybe they buy 2 or 3 short-term rentals, they max out their DTI, they need to either make more money from their W-2 or real estate to increase their DTI. So maybe they decide to park money in a syndication instead, or they're using syndications as ways to help offset some of their exit strategies out of their own portfolio. So you might have people who they've been mom and pop landlords for 20, 25 years, and they're looking to eventually get out of real estate, and they don't want to manage the properties anymore. Well, those are some people that really should consider selling their portfolio outright and then also reinvesting in syndications and then using that to funnel to not only offset the capital gains tax burden, but to also generate some more of those income streams in the future. Thanks everyone for tuning into the podcast today. Make sure to get in touch with me at Learn Like a CPA on all social media platforms. Also, make sure to check out the Facebook group. That's going to be Tax Strategies for Real Estate Investors. We have over 5,000 real estate investors in that group. Conversations going on every day about markets, tax strategies, etc. So make sure to sign up today.